We are still on the full year season for commercial banks releasing their earnings, and we're delighted to have the man from KCB Group, Lawrence Kimathi, GFD. Welcome on set.
Thank you, Julian.
Lawrence, interesting set of numbers. Strong momentum from what I'm seeing. But one issue which has really spooked investors, if I could say, is the question of the dividend. And whereas we understand you've taken some heavy investment in the recent past, TMB, etc., from my perspective, I thought at least the dividend yield at the bare minimum should beat inflation.
Good question, Julian. And it's something that we really debated and talked about in the board and in management as well. So one is we are paying a dividend. It is lower than what we paid in 2022, but we are paying a dividend. So at least that is a good sign. I'll say that we've got, in making this decision, we've got to look at the holistic picture and have long-term view in mind. We invested heavily in acquiring TMB, came towards the end of the year. We believe commercialization of that acquisition is something we should be able to do in a year, max 15 months. There's some investment that needs to go in there, core banking system changes and all. And in a very short period of time, the shareholders will actually be seeing an improved dividend payout into the future. But we had to take a decision to protect the capital base of the bank.
Yeah. And to be fair to KCB, KCB has been relatively consistent on the subject of dividend.
Absolutely. Yeah. I mean, even when other banks didn't pay dividends during COVID for various reasons, we consistently maintained the payment of dividends. We might have tweaked it in terms of amount, but we were quite consistent. We have not stopped paying dividends, at least not since I've been at KCB.
KCB looking quite countercurrent when I look at it vis-a-vis other players, non-funded income really pulling its weight. And I was curious because in the previous conversation I've had with Paul Russo, is that when I look at the structure of TMB, they have a very heavy non-funded side. I mean, granted, they're really new into the space, but to what extent did they play a role in this?
So for 2022 performance, actually their role was extremely small because remember we actually closed the deal in December. So their performance consolidated into 2022 was really just for 1 month. The non-funded income performance was largely coming out of the other, the already existing businesses, BPR, full year impact of BPR. But specifically the markets that we've been there for long. KCB Kenya had a fantastic year on NFI. Key lines that delivered was lending fees, service fees, and FX. FX played a massive role. Other income where we normally would have trading income from government securities was a bit subdued. Secondary market, as you know, for government paper was really silent. Yes. In the year.
Okay. And speaking about FX, across the industry, understandably, it is quite a mover and shaker in these earnings. We now have a G2G deal as far as oil is concerned. And the question here is, do you feel exposed as banks going forward?
I wouldn't say we feel exposed. I think it's a right thing for government to do. So, the G2G will as you know, the biggest outflow in terms of foreign currency from a government point of view is buying oil, fuel for the country. So G2G gives a reprieve for at least 6 months because you're getting almost 6 months credit for the outflow. And in that time, there are many other moving parts. You expect that some of them will come to play and help in terms of stabilizing the shilling. If stabilization of it means that the spreads are then impacted, at the end of the day, it will be what it will be.
Portfolio quality. KCB still flying above the industry average. Now I think it's about 17. And you have given a guidance of 13 for this current year, 2023. And maybe the question now here is what strategic moves are you taking to realize that?
So what we discussed in last year. Remember, we picked our NPL peaked at 21.5 in June, and we were quite upfront and said we are looking at various ways rehabilitation of customers, externalization of the debt, just writing off. All those strategies are starting to bear fruits. Even in the manner in which we do our underwriting, we have been very specific, a lot more stringent, so that to ensure that whilst we are sorting the past, we are not also creating a problem for the future. And you're right, it's one number that we are not proud of. It's one number that, as I said earlier on, I do love talking about double-digit growth. Certainly not when it comes to double-digit NPL. So we are working to make sure that number goes down. We are sitting with 161 billion of loans that are not earning the balance sheet. They are not earning us much. So it is a whole bank. Actually, it's probably a top 10 bank. So the quicker we get that sorted, the better for our future growth. And the entire Exco is looking at this. We've created a team that is doing their only piece of work is to making sure that we get that right, and that team reports directly to the GCEO.
Okay. And I'm really curious still on this issue of portfolio quality. How is TMB looking from an NPL perspective?
TMB is actually quite okay. Their number that is about, I think, 9%, single digit. When you look at, and you will see it when we publish our integrated report, just the TMB numbers, you'll realize that they have a very low loan-to-deposit ratio. They don't actually, whilst they are a bank, they make money out of their non-funded service fees. They make money out of monetizing the deposits that they have, the dollar deposits, by either placements or investing in government paper out of GRC. So their loan is not a very big, strong part. KCB coming in with the balance sheet, we are able to be choosy and go to big, mining companies or cement companies or some of those big corporations that they could not be able to lend to before because of the size of their balance sheet. So overall, they are dilutive to the group NPL number, but because they do have a non-performing value, it comes into the 161 NPL number. I think it's about 8.6 billion, if I remember the number correctly.
Okay. And at the group level, when you look at your local currency denominated book versus your foreign currency denominated, how are they looking on a portfolio quality view?
The bulk of the NPL is actually coming out of local currency book. It's 80% of the entire book, and that's where we are seeing a lot of issues. We do have customers who have actually approached us and they want to convert from foreign currency book to local currency, and we are looking at because of the FX risk. Because as we lend, customers come to us and ask to be lend in foreign currency. One of the areas we make sure is that they have inflows in foreign currency, in the same currency as they're borrowing, they would like to borrow from. So when there's constraint in that inflow from their side, and they need to pay us using the foreign currency, they are finding it a bit difficult, and we are happy to accommodate moving their facilities to local currency.
By the way, how does that impact pricing of the instrument?
Well, you convert it to the local currency pricing.
Okay, yes. I see. We seem to be backpedaling on efficiency based on the latest numbers. Could you just comment on that? Yeah,
so one thing, when you do acquisitions and you do acquisitions in the middle of the year or the end of the year, you will have a mango and bananas comparison. So for instance, 2022, we had the full year impact of BPI in our costs. But in 2021, we only had 5 months. So you see, when you do that comparison, you'll always have that mismatch. 2023 will be the same because we'll have a full year of TNB, but in 2022, we only had one month. So again, it does distort. But so if you take out that distortion, and a few one-offs that came our way, which we had not foreseen, our increase in costs is about 14%. In itself, still a large number, a large double-digit number. It's largely driven from a lot of investments we've done in technology. We did change the core banking system for BPR because we needed to unify KCB, Rwanda and BPR into one core banking system, and we needed to do it very quickly. The regulator had given us timelines to do that by end of last year. So we threw a lot of our resources to Rwanda to make sure that came through. So that has had an impact on our efficiency. It will continue into 2023 because we are doing the same for TMB. They were in the process of changing their core banking system. They had even done an RFP and they were about to award when we were doing the acquisition. So we told them, hang on, let's defer that decision until we close the deal so that we are on the same platform. So that cost is going to come into 2023. KCB Kenya and NBK again is also going into an upgrade of core banking system. So we see investment in technology coming through. So I'll say last year, this year, heavy investment coming through. We should see benefits of that coming out in 2024.
Okay. Lawrence, I looked at the group's capital adequacy numbers and I was a little bit concerned. Not too much, but a little bit concerned, especially considering a bank of your size.
Absolutely, and it goes back to your first question on dividend. The answer I gave, we have got to protect the capital of the bank. It doesn't make sense for us to declare a very big dividend and then within 6 months we do a capital call. It just doesn't make sense. So, bide your time, let the bank generate its own capital organically, and then you can be able to see how to pay dividends. So you're right. When I look at the buffer for KCB Bank Kenya, at total capital level, it's about 70 bips. I think we have at 5. It's about 80. We had 5.3 with the dividends that have been declared against a regulatory minimum of 14.5. So we had 15.3. So we know that it is close. We've done our stress testing. We believe within this first half of the year, we will go back into comfortable levels because KCB Kenya just generates a lot of capital. But we can't, there are headwinds all over the place. The macro environment is not as stable as we would like. So that's why we are being cautious and saying 80 bips is good enough for us for now. Had we added an additional shilling, like I'm sure you'd have wanted, that buffer would have come a lot to a place where it would make me have sleepless nights.
So Lawrence, the group CEO did mention that within a fortnight we do expect to get some info as far as your risk-based pricing is concerned. When you look at the runway ahead in 2023, what sort of momentum build-up do you think that will afford you, especially when you focus on loan repricing?
Yeah, so we do expect to get the pricing approved by the regulator in the coming 2 weeks. But again, in the economy we are operating in, much as cost of funds has gone up, no doubt about that. You've got to tie ability to pay to the decision you make on pricing. The last thing you want to do is create a problem 2 years out. So increase your lending rates now because you get a nice quick gain today, but then in 2 years' time, a year or so, the guys are unable to pay because the cash flow is just then the default. Yeah, so it's a balancing act. We've got to look at it case by case. We've got to understand the risk that we're taking first. What is the risk rating of the customer we are dealing with, and what is the ability to pay? Look at their cash flows and make that decision. One thing I say, and I've said this even when I was in the FMCG world, I've always looked at price increase as one of the laziest ways of managing a business. It's quick, you hit your targets for the year, but is that the sustainable way of running an organization? The answer for me is it's not the sustainable way. Doesn't mean that you don't take increases when they are warranted. Yeah.
Okay. We've received indication this morning from the chairman that KCB is engaging with potential target entities in Ethiopia. And I'm just curious, what shape and form of a target entity would you be looking at, especially when you look at the wholesale retail mix?
So we have scanned the market in Ethiopia. We actually have had meetings with a number of banks. We've shortlisted. We are comfortable with a couple of banks that we believe fit our strategic profile. We are looking at a bank that is tech savvy. We are looking at a bank that has a spread. Unfortunately, well, let me not say unfortunately, but because of the regulatory requirement in Ethiopia, there's a number of branches that a bank is required to have every year, to actually increase by every year. So footprint is not an issue. All the banks will have significant footprint in the market. So just supporting the retail and the corporate banking the way we are as a universal bank and the technology side is what has led our shortlisting. And then the last part is chemistry. We in the shortlisting we've actually had conversations with the boards of those banks that they've had the conversation with our boards just to understand whether there is a rapport, there is chemistry that comes through, because the last thing you want to do is go invest. I don't know whether you had a chance to look at the proposed legislation. It does not give foreign banks majority. So the max that you can get in is 30%. So you'll be coming in as a minority. So chemistry becomes extremely important. It's not like when you can become the majority and you basically can take decisions because you have a majority. So those are some of the aspects that we've looked at. We believe that legislation will be discussed in Parliament in a matter of months. So we are looking forward to that change.
Okay. Let's wrap up this conversation, Lawrence. And we've had this conversation with KCB before, but maybe now just looking at 2022 going backwards. KCB is involved in the Hustler Fund, especially from the credit scoring standpoint. What key learnings are you getting, which you think then are shaping your outlook in this market?
So the reason why we are involved in the Hustler Fund is because of our knowledge of the market, especially that segment of the market. As you know, we've had KCB M-Pesa for a long time. We've been part of the Fuliza conversation. We have our own mobile lending product within our app called Mobi. So the lessons we brought in were quite instrumental in shaping how Fuliza has turned out to be, especially in light of the conversation that was had on CRB, the changes that are going through on CRB, the customers who were already blacklisted, taking all that into account, we had our own way of communicating and advising government of what to expect in terms of when you go to market, and that partnership has been quite strong. We expect. I'm sure you know that the Fuliza limits were expanded not too long ago. President pronounced that, and I expect that that again is very likely to increase in the course of this year.
Okay. Final question, Lawrence. Comment a little bit about your subsidiary NBK. I looked at the numbers. The bottom line moved down a bit, and also the recapitalization.
Yes. So NBK is one of those subsidiaries that is key, top of the agenda for 2023. It has got to work. Not that it hasn't worked previously, but it has not delivered the targets that we've set for them. This time round, they were hit by again a last minute fair value valuation on a particular client that impacted their profitability. But and I think we alluded to this in the meeting during the presentation. We have got to get the core banking system for NBK aligned to the KCB Kenya core banking system. That allows us then to be able to get the back office being managed centrally under a shared service center. By so doing, you create efficiencies. Yeah, you will definitely create efficiencies. That's one on the back end. The second thing it does is that it enables us to be able to do branch rationalization, because then you can, a customer of KCB can go into an NBK branch in Marsabit if NBK is the most prominent branch in that area, and we can close KCB. Likewise, in a different part, we can do the reverse, and that will release quite a bit of value. When we bought NBK back in 2019, this was one of the key areas that we had seen. Their cost-to-income ratio was sitting at about 85%, and we believed that we could get that down to close to 50. So that unlocks quite a substantial amount of value. And that is a focus. So, with the new MD, George, he's got his work cut out for him. On the recapitalization side, we expected that NBK, based on performance of 2022, they should have been able to generate enough organic capital to be able to get compliant. But as I said, with those one-offs that came in towards the end, that was apparent that it wasn't going to happen. Yesterday, the board approved for us to put in some Tier 2 capital into NBK, and that should be concluded in a matter of months.
Okay. Lawrence Kimathi, thank you so much for your time.
Thank you, Julian. It's always a pleasure.
Appreciate it.
Thank you.